Hi there, tax accountants. I hope all is well, and I pray that as you're viewing this video, that you're in the best of health and spirit. This video will cover several questions from Cengage, corporations, partnerships, estates, and trusts from Chapter 2, which covers the deduction for qualified business income for non-corporate taxpayers. Chapter 3, which covers corporations, introduction, and operating rules. And Chapter 4, which covers corporations, organization, and capital structure. So our first question, it asks Megan's QBI deduction is. So before we start to look at the problem, we'll, just go over the background information as it relates to qualified business income deduction, also referred to as QBI or QBID, qubit. So in 2017, it was a very big tax change, Tax Cuts and Jobs Act, often referred to as TCJA. And there was a decision to reduce the top federal corporate income tax rate to a flat 21%. Before, corporations had a progressive tax rate, much like individuals. So the more income they earn, the higher their tax bracket, essentially their effective tax rate. But Congress decided that they were going to make it a flat 21% for various corporations. Therefore, Congress, they needed to provide a means to reduce taxes for businesses that did not operate as a C corporation. So for sole proprietorships, partnerships, and S corporations. So in order to account for that, Congress accomplished this with the creation of the deduction for qualified business income. And this is also referred to as Section 199A, and it applies to non-corporate taxpayers. So in general, the deduction for qualified business income, it's 20% of qualified business income, QBI. But there are certain limitations, as we will see. So for this first problem, it states Megan's QBI deduction is in 2024, Megan, a single taxpayer, has QBI of 110,000 and modified taxable income of 78,000. This is also her taxable income before QBI deduction. Given this information, what is Megan's QBI deduction? All right, we are going to pull up an Excel. All right, so as it relates to QBI, right, at its most basic level, before considering any limitations, as mentioned, Section 199A or QBI, Qualified Business Income Deduction, it permits an individual, an entity, non-corporate taxpayers to deduct 20% of qualified business income that's generated. So QBI, it's defined as ordinary income less any ordinary deductions that the taxpayer earns from the qualified trade or business. So at its most basic level, again, it's essentially 20%. There are some limitations, ultimately depending on the individual's income. There's 3 limitations in total. An overall limitation that's based on a modified taxable income, another that applies to high income taxpayers, and a third that applies to certain types of businesses. So as it relates to the second and third limitations for high income taxpayers and for certain types of service businesses, those limitations only apply whenever the taxable income before the QBI deduction, if it exceeds $383,900 for married taxpayers filing a joint return, or $191,950 for those filing as single and head of household. So again, there are some limitations. But in this case, we see that Megan's modified taxable income, 78,000. It is far below the threshold of $191,950. So therefore, it seems as though we're going to be good to go. So in order to determine what the QBI deduction would be, the first thing we need to determine is, in general, the deduction for qualified business income is the lesser of 20% of qualified business income, or 20% of modified taxable income. So in this case, the qualified business income, as the problem lets us know, is $110,000, and the taxable income before the QBI deduction is $78,000. So multiply by 20%, 20%. All right, so in order for us to determine the deduction, so 110,000 multiplied by 20%, that will be 22,000, versus the modified taxable income multiplied by 20%, which would be 15,600. So again, Megan is not subjected to any limitation. Therefore, determining her qualified business income deduction is easy. We basically take the lesser of the two. In this case, 15,600 is the lesser of two. So therefore, Megan's QBI deduction is 15,600. Fairly simple and straightforward. So now we move on to this next problem. And here we see it's asking us to compute Henry's QBI deduction and his tax liability for 2023. And it wants us to actually prepare the form 8995. So generally, what will happen is that if you have a client, let's say they have a Schedule C, you input all of the information for the Schedule C, and this form that we are going to prepare is automatically calculated. There's just nothing that needs to be done. But just to ensure that you understand the nuance behind what is happening, what is being reported on the form, we're going to go through it. So A states, compute Henry's QBI deduction and his tax liability for 2023. In 2023, Henry Jones' Social Security number 123456789 works as a freelance driver, finding customers using various platforms like Uber and Grubhub. He is single and has no other sources of income. In 2023, Henry's qualified business income from driving is $63,200. Assume Henry takes the standard deduction of $13,850. So, in order for us to determine the QBI deduction, as we know, at its most basic level, it is going to be based on, and you know what, actually, to make this easier, we'll actually start with B first. We'll start to complete the 2023 form 8995. So keep in mind, business income is $63,200, standard deduction of $13,850. So I'll work backwards. So here we have the form Henry Jones. It has his taxpayer identification number. So it lets us know that the qualified business income or loss is $63,200. And then line 2 asks for the total qualified business income or loss. It asks us to combine lines 1I through 1V. So the only thing for Henry in this case is 1I. So the total qualified business income is $63,200. Line 3 accounts for any qualified business net loss carried forward from the prior year. It is 0. So therefore, on line 4, our total qualified business income is $63,200. It asks us to combine lines 2 and 3. So $63,200 plus 0 is $63,200. Line 5 asks us to calculate the qualified business income component by multiplying line 4 by 20%. So 63,200 multiplied by 20% gives us 12,640. Line 6 asks if there's any qualified REIT dividends and publicly traded partnership income. Line 7 asks for qualified REIT dividends and qualified PTP loss carry forward. And the total 6, 7, and 8 does not apply. So line 9 asks us to multiply line 8 by 20%. So 0 multiplied by anything is 0. So line 10 asks us to add lines 5 and lines 9. So 12,640 plus 0 gives us 12,640. Now line 11 asks us for the taxable income before the qualified business income deduction. So if we scroll up, the problem lets us know that his qualified business income from driving is 63,200. He has no other sources of income. And the standard deduction is 13,850. So to determine our taxable income before the qualified business income deduction, it would be the 63,200 minus the standard deduction of 13,850. So therefore, the taxable income before qualified business income or deduction, again, it is the earnings from the business. So it's our qualified business income minus the standard deduction, which gives us $49,350. We check line 12. It asks to enter your net capital gain, if any, increased by any qualified dividends does not apply. So line 13 asks us to subtract line 12 from line 11. So if we subtract 0 from 49,350, we would get the same amount. And line 14 asks us to multiply line 13 by line 20. So we multiply our taxable income before the QBI deduction, 49,350, multiplied by 2. That gives us 9,870. And then for line 15, it asks us to enter the smaller of line 10, which is 12,640, or line 14, which is 9,870. So lesser of the two is the 9,870. Line 16 asks us for the total qualified business loss carry forward. 0 does not apply. And the total qualified REIT dividends and PTP loss carry forward, this does not apply. So this is also 0. So we completed the form 8995. And again, the program automatically calculates this, but it's good to get an understanding of how the form is calculated. Now, if we scroll back up, it asks, what is the QBI deduction? So we just calculated it. And the QBI deduction is the 9,870. And now the next part of the step is essentially asking us to determine what the tax liability is. So here we calculated the taxable income before the QBI deduction, the 49. So we'll start from the top, 63,200 minus the standard deduction of 13,850. That is how we calculated the taxable income before the QBI deduction. We calculated our QBI deduction. So from this 49,350, we subtract 9,870. So therefore, the taxable income in this case is $39,480. So in order for us to determine the tax liability, we scroll up. We go to the 2023 individual tax rate schedule. And now the next step is for us to determine what the tax will be. So here we see for a single individual, his income is over 0 and it is over $11,000. So therefore, we don't use this range. His income is over 11,000, but it's, so let's scroll down, 39. All right, yep, his income is over 11,000, but it's not over 44,725. How much is it? It's 39,480. So in order to solve the problem, the first thing we need to do is our taxable income minus the base, which is 11,000, because we want to determine, okay, how much exceeds this 11,000? So $28,480 exceeds the 11,000. So therefore, we multiply the difference by 12%. That gives us $3,417 per 60 cents. And then we add the base tax, which is $1,100. And that gives us $4,517.60. And if we round it, it'll be $4,518. So again, we started off with the QBI income of $63,200. We subtracted the adjusted gross income of $13,850. This $49,350 represents our taxable income before the qualified business income deduction. We calculated our qualified business income deduction of $9,870, and that gives Henry taxable income of $39,480. So in order for us to calculate our tax liability, we know that the taxable income is over zero and it is over 11,000. So therefore, we move on to the next bracket. The taxable income is over 11,000, but it's not over 44,725. This is correct. The taxable income is 39,480. So therefore, we have our base tax of 1,100 plus 12% of the amount that is over 11,000. So this is our taxable income. We subtract the 11,000. That gave us an excess of 28,480. We multiplied that by 12%, and then we add our base tax of 1,100. And that is how we calculate the tax liability of $4,518 rounded. So that brings us to the end of this problem. This question asks, determine the amount, if any, of the net capital loss of $33,500 that is deductible in 2024. And B, determine the amount, if any, of the net capital loss of $33,500 that is carried forward to 2025. So one key distinction between individuals and corporations. So both individuals and corporations are tax-paying entities. However, there are some differences. So unlike individuals, corporate taxpayers, they are not permitted to deduct any capital losses against ordinary income. So that's one of the key differences. Individuals are allowed to deduct up to $3,000 per year. Corporations, on the other hand, no capital losses are allowed to be deducted against ordinary income. However, capital losses can be used only as an offset against capital gains. So, as a result, if the current capital gains are insufficient to offset the current capital losses, then the corporation has no current deduction for the excess capital loss. So, for this first problem, or this first question rather, it says Goose Corporation, a C corporation, incurs a net capital loss of $33,500 for 2024. It also has ordinary income of $26,800 in 2024. Goose had net capital gains of $6,700 in 2020 and $13,400 in 2023. So it's asking us how much of the net capital loss incurred in 2024 is deductible in 2024. So in the case of Goose Corporation, the problem does not let us know that they have any capital gains in 2024. So therefore, zero. None of it can be deductible. Why? Because in 2024, there are no net capital gains. So therefore, since the corporation does not have the ability to claim any excess net capital losses, they are allowed to essentially carry it back 3 preceding years, and then from there, they can carry it forward. So that's one of the things to keep in mind. So in this case, B is asking us to determine the amount, if any, of the net capital loss of $33,000. So in order for us to determine this amount, we essentially have to consider, all right, what is taking place in the problem? When was there a carry forward, or well, what was the net capital gains rather that we need to account for? So in this case, we see that there's a total net capital loss of $33,500. And as mentioned, we're allowed to carry back the capital loss to 3 preceding years. So 2020 is out of the question. The question is asking us about 25. So therefore, 2020 is out of the question. We cannot go back more than 3 years. However, there was this capital gain in 2023, which falls within the period. So therefore, 33,500 minus the 13,400, that represents a carry forward loss of 20,100. All right, and again, we do not account for the $6,700 because the net capital loss is carried back only 3 years. So a 2024 loss cannot be carried back to 2020. So just keep that in mind. So again, how do we calculate this 20,100? We know that in 2024, none of the capital loss is deductible in 2024 because there were no net capital gains, but they are allowed to carry it back 3 years and then forward. So 33,500, which represents the loss, minus the capital gain in 2023, which falls within the 3-year period. 20,100 is the carry forward to 2025. All right, so this brings us to our next question. It asks us to compute the dividends received for Crane Corporation and compute the dividends received for Loon Corporation. States Crane and Loon Corporations, 2 unrelated calendar year C corporations, have the following transactions for the current year. We have gross income from operations, expenses from operations, and dividends received from domestic corporations with 15% ownership. All right, so in order for us to determine these amounts, it's going to be deductible. So one key thing to keep in mind is that with the corporation, one of the downsides is that there's what's called double taxation. So as we mentioned a bit earlier, corporations are considered a tax-paying entity, much like individuals. And essentially what happens is that corporations, they file their tax return and they pay taxes on a flat 21% of all income. So it doesn't matter if the income for the corporation is $100 or $1,000, $100,000, $1 million. There's a flat 21%. So the corporation pays taxes on the 21%, and then when they issue dividends to the shareholders receive what's called Form 1099 DIV, and then they report that dividend distribution on their tax return as income. So this is one of the biggest disadvantages of a corporation, the double taxation. So to help mitigate that, especially in the event that it is from a corporation to a corporation, because sometimes corporations invest in the stock of another corporation. So in that case, it will be like triple taxation. Both corporations pay taxes, and then the shareholders also pay taxes. So to help mitigate that, we have what's called the dividends received deduction. So as it states here, the purpose of the dividends received deduction is to mitigate. We're going to make this a little bigger. All right, so the purpose of the dividends received deduction is to mitigate multiple taxation of corporate income, as I just mentioned. So without the deduction, income paid to the corporation in the form of a dividend will be taxed to the recipient with no deduction to the distributing corporation. And then later, when the recipient corporation pays the income to the shareholder, it's again subjected to taxation. So as it relates to the dividends received deduction, it depends on the ownership percentage. And this includes both voting and value. The recipient corporate shareholder holds in a domestic corporation. So in such case, if it's less than 20%, the deduction percentage is 50%. If the corporation owns 20% or more, but less than 80%, then the deduction percentage is 65%. And if they own 80% or more of the corporation, then the deduction percentage is 100%. So there's some steps to take as we are trying to determine the taxable amount. So the first thing we'll do, step one, and then we'll start off with crane, and then we have loan. So 50%, and here it lists us somebody that have 15% ownership. Now we're gonna do what we two for each. All right, so we have 50% of the dividends received because they own less than 15%. So for Crane, the dividends received are 100,000. We multiply it by 50%. So the dividends received will be 50,000. For Loon, the dividends received 230,000 times 50%. So that's step one, multiplying the applicable deduction percentage by the total dividends received. And now for step two, we multiply that same percentage because the steps are as follows. We multiply the dividends received by the deduction percentage. Step two, we multiply the taxable income by the deduction percentage. In step three, the deduction is limited to the lesser of step one or step two, unless deducting the amount derived in step one results in a net operating loss. So taxable income before the dividends received. How do we determine that? So for Crane, our taxable income is calculated as follows. 180,000, which represents our gross income from operations, plus the $100,000 that represents dividends, minus the expenses from the operation of 255,000. All right. So our taxable income before the dividends received deduction is 25,000. And then for Loon, we follow the same steps. Gross income of 300,000 plus the dividends received of 230,000 minus expenses from operations of 310,000. I think I have an extra zero. 300,000, 230,000. All right, perfect. All right, so now the next step is that we're gonna multiply these amounts by 50%. We're just gonna move these to the left, to the right rather. All right, so taxable income before dividends received for Crane is 225,000. We multiply it by 50%. That gives us 12,500. And then we do the same thing for Loon in order to determine the dividends received deduction. So 220,000 multiplied by 50%, which is 110,000. So we need to ultimately determine, are we going to take the lesser of step one or step two, or does claiming the full amount of dividends received deduction create a loss? So in this case, and here's how we would determine the amount. I'll shift these down. And again, the key thing that it says here is us claiming the amount derived from step one, is it going to create a net operating loss? So for Crane, this is the taxable income before the dividends received deduction. If we claim $50,000, the amount derived from step one, it is going to give us a net operating loss. So 25,000 minus 50,000 would give us a net operating loss of 25,000. So based on this information, in step three, as we look at Crane, generally we take the lesser of step one or step two, but because in this instance, claiming the full dividends received deduction creates a net operating loss, for Crane, he takes the full $50,000 as a deduction. Now for Loon, on the other hand, the income before dividends received deduction is 210,000. If we were to claim the full 115,000 and we subtract the 220,000 minus 115,000, that would give us net income of 105,000. So therefore, this rule does not apply for Loon. Instead, we compare the two and we see that 50% of the taxable income before dividends received deduction is the lesser of the two. So therefore, Loon's dividends received deduction would be $110,000. So again, the key thing, we start off with step one, we multiply the applicable percentage by the dividends received. Step two, we multiply the applicable percentage by the taxable income before dividends received deduction. And then in step three, we generally take the lesser of step one or step two, unless deducting the amount derived in step one, as we see here, 25,000, which represented taxable income before DRD, minus the dividends received deduction calculated for Crane, which gave us a net loss. So in such case, we took the dividends received deduction because it created a net loss. Versus for Loon, if we claim the 115,000, there would still be net income. So therefore, we choose the lesser of the two, and in this case was $110,000. For step three, question 330, it asks us to compute the current year liability for each of the following unrelated calendar year C corporations. So as mentioned previously, the Tax Cuts and Jobs Act of 2017 reduced the corporate tax rate to a flat tax for years beginning after 2017. It is no longer progressive like the individual tax rate. Things might or might not change because the Tax Cuts and Jobs Act, it is expiring in 2025. So I guess we just need to wait to see what happens. But as of right now, calculating this problem is fairly simple. So we have Darter Corporation has taxable income of $68,000. So $68,000 multiplied by 21%. Tax liability in such case is $14,280. Next, we see our corporation has taxable income of $10,800. And that gives us a tax liability of $2,268,000. And then lastly, we have Toucan Corporation, a personal service corporation that has taxable income of $170,000. So a personal service corporation, also called a PSC, this is basically where the principal activity, the performance of personal services are performed by shareholder employees. So the performance of services, they have to be in the field of engineering, accounting, consulting, performing arts. But even in the midst of a corporation being a personal service corporation, the flat 21% rate also applies to these personal service corporations. So 170,000 multiplied by 21%. There's a tax liability to this corporation of $35,700. And this problem asks us to determine Marie and Ramesh's current income, gain, or loss, and calculate the basis that each takes in the Roundtree stock. Marie and Ramesh form Roundtree Corporation with the transfer of the following. Marie performs personal services for the corporation with a fair market value of $80,000 in exchange for 400 shares of stock. Ramesh contributes an installment note receivable with a basis of $25,000, fair market value of $30,000, land with a basis of $50,000, fair market value of $170,000, and inventory with a basis of $100,000, fair market value of $120,000 in exchange for 1,600 shares. So in this chapter, we learn about what's called Section 351. So generally, whenever there's property transactions, it'll result in what's called a recognized gain or loss whenever they realize the gain or loss. So there's a difference between realize and then recognize. So realize, that is essentially, there's an appreciation in value. Let's say I purchased the building several years ago for $1,000, and now the building is worth $10,000. There's a realization, right? There's a realized gain. $10,000, which represents how much it is worth now, versus $1,000, which represents how much I paid for it. It's just realized, however. Recognized is when it is reported for tax purposes. So this is when I sell the property. And when I sell the property, I now have the 10K, and then the 9K represents the taxable amount, which is the return on capital. But we have what's called Section 351, right? Because imagine if every time, or we use the same scenario. I have this building, it's worth $10,000, but I paid $1,000 for it. I own the building. Now I decide that I want to start a corporation in which I am the sole shareholder, and I want to put the building into the corporation. Imagine if I have to pay $9,000 on the appreciation in value, right? When you think about it, there's also what's called the wherewithal concept. If I didn't sell the property, I don't have the wherewithal to pay taxes on $9,000, right? So with this Section 351, this basically is in the Internal Revenue Code, and it permits the non-recognition of gain or loss in limited circumstances. So just like if there's a like-kind exchange, Section 1031, Section 351 is essentially the same, because if we think about it, in the example that I gave, I own the building before the corporation. And once the corporation is formed and I transfer the building, I still own the corporation. So there's no substantive change. So here we are with Section 351, and we know that there are several requirements. The 3 requirements are, first and foremost, property needs to be transferred. Second, it's in exchange for stock. And 3, the property transfers are in control of the corporation after the exchange, and control is determined as 80%. So non-recognition of gain, it occurs only when the shareholders receive stock, and stock, it includes common and most preferred shares. So now in this example, we need to consider, all right, first and foremost, what's the value of each share? And then we also need to consider, here she provided personal services. So one key thing to keep in mind is that as it relates to property, property can be cash, it can be building and equipment, it could be generally mostly any other form of an asset. However, for purposes of Section 351, services is not considered included, but there is a caveat. If the individual contributes both services and property, then there is, as mentioned, a little caveat, right? What happens with that is that if the individual transfers services and it's what's called a relatively small property contribution, then that individual is allowed to have their ownership percentage count towards the control requirement. So we're going to look at this example here. She performed the personal services, but in this case, it does not tell us anything about Marie contributing both personal services and property. So in such case, Marie is going to have to recognize income of $80,000. Services does not count. And here we see she has 400 shares and Ramon has 1,600 shares. So Marie is going to recognize the income, and then her basis in the stock is going to be 80,000. And keep in mind, even if Marie did contribute both services and property, whenever services are performed, you are always going to have to recognize as ordinary income the value of the services provided versus the stock compensation that was received or transferred rather for the services provided. In this case, she performed personal services, fair market value of 80,000 in exchange for 400 shares of stock. So Marie recognizes that income for her and the basis of 400 shares of stock. Now we consider Ramesh. So Marie has 400 shares. Ramesh owns 1,600 shares. So there's a total of 2,000 shares. So 16,000 or 1,600 rather divided by 2,000. Oh, okay. Hey, Ramesh met the 80% control requirement. That's one of the requirements. So the first one is that property is transferred. And in this case, we see Ramesh contributed an installment note receivable, land, and inventory. So requirement 1 is met. Requirement 2 is that there's an exchange for stock. So it lets us know that he received 1,600 shares of stock. It doesn't say that he also received cash or anything else. And then lastly, the property transferors are in control, which means that they own at least 80% of the stock. So in this case, all 3 conditions have been met. So therefore, Section 351 applies to Ramesh. So in such case, $0. He has no income that needs to be reported. And in order for us to determine his basis in the shares of stock, it would be as follows. The basis in the installment note, the basis in the land, and the basis in the inventory. So whenever Section 351 is met, the basis for the individual is equivalent to the basis and the gain or loss that is not being recognized. So in this case, his basis is $175,000. This brings us to our next question. And it asks, because this transaction blank the control of the corporation requirement, Grady has blank of and blank basis in shares of stock. Calculate Grady's current income, gain, or loss, and the basis he takes in his shares of ED stock as a result of this transaction. So it says Grady exchanges property with a basis of $12,000 in fair market value of $18,000 for 60% of ED Corporation. Pedro acquired the other 40% of the stock 5 years ago. So based on this situation, we scale back to the rules for Section 351. For the transaction to qualify as non-taxable, the 3 requirements are property is transferred in exchange for stock, and the property transfers are in control, which means 80% or more. So here it says Grady exchanged the property for 60% of the stock, and Pedro acquired the other 40% of stock 5 years ago. So Section 351, it does, apply to existing corporations, but the same rules apply. The individual needs to be in control 80% or more. So based on this information, unfortunately, this transaction does not meet the control of the corporation requirement. Grady has to recognize a gain. And how much is the gain? The fair market value of the property is $18,000, and the basis of the property that Grady exchanges is $12,000. So therefore, he has a gain of $6,000. And whenever Section 351 is not met, the basis in the stock is equivalent to the fair market value of the property that has been transferred. So Grady's basis in the shares is $18,000. So again, because Grady exchanged property for only 60% of the stock and Pedro acquired the other 40% 5 years ago, Grady does not meet the requirement. This next problem it asks us, Diego has a recognized gain on the transfer of blank and a basis of blank for his stock. Diego transfers real estate with an adjusted basis of $260,000 and fair market value of $350,000 to a newly formed corporation in exchange for 100% of the stock. The corporation assumes the liability on the transferred real estate in the amount of $300,000. All right. So sometimes when a corporation receive transferred property, they might also assume a liability, right? So the individual might be transferring a property, but there's a mortgage on it. So the corporation is now assuming the liability. So now one of the challenges with doing such is that there's what's called section 357A. Because we have to consider it like this. The party that's enjoying the debt relief, they would essentially have to treat it as income. So as it relates to individual taxation, let's say you have credit card debt and the credit card debt is written off. Let's just say that the credit card amount was $3,000 and then the company wrote it off. It went into collections and then they realized it was uncollectible and they wrote it off. So $3,000 no longer needs to be paid to the credit card company. However, in the mail, you would expect to receive what's called a Form 1099-C. And then on your tax return, you would need to report that $3,000 as income. And I guess the logic behind it is that if you had the money, your income, you would use that money to pay off your credit card bill. So therefore, it would be treated as income. But with this rule, section 357A, it essentially determines that whenever a corporation assumes a liability in a section 351 transaction, the liability is not considered boot received for gain recognition purposes. However, please keep in mind that the liabilities assumed, they do impact the basis of the stock by the shareholder, but again, they are not treated as boot for gain recognition purposes. So in this problem, here we see Diego transferred real estate, basis of $260, fair market value $350, and then they assumed liability of $300,000. So in order for us to determine these amounts, the mortgage assumed is $300,000. But then it lets us know that his basis is only $260,000. So therefore, Diego has a recognized gain of $40,000. And then the next thing is that we need to consider, well, what is his basis? And his basis will be calculated as follows: $260,000 for the property transferred, plus the $40,000 gain that he received, minus the boot received. In this case, the boot received is $0. And then from there, we subtract the liability assumed. So therefore, his basis in the stock would be $0. So again, the calculation would be the basis in the property transferred plus the gain recognized by the shareholder minus boot received, if any, minus the liability that has been assumed. And based on that information, that is how we determine Diego has a $0 basis for his stock. In this example, we start to look at section 1244. So we know that with capital losses, especially as it relates to individuals, there is a limitation. You can only claim a maximum of $3,000 per year. But with section 1244, this is one of those exceptions. So Section 1244 permits special loss treatment for losses on a sale or worthlessness of stock for so-called small business corporations. So in this case, it states, determine the amount and nature of Minjung's gain or loss recognized this year in each of the following scenarios. In 2016, Minjung, who is single, acquired original issue stock in Blue Corporation at a cost of $60,000. This stock meets the definition of both Section 1202 and Section 1244. This year, Minjung sold the Blue stock. So with this Section 1244 as mentioned, there's essentially a provision whereby the amount of ordinary loss deductible in any 1 year from the disposition of the Section 1244 stock, it's limited to $100,000 for spouses filing a joint return and $50,000 for everyone else. So in this case, A asks if the stock is sold for $5,000. So if the stock sells for $5,000 minus the basis of $60,000, this gives us a $55,000 total loss. But again, due to Section 1244, Minjung would be able to claim $50,000 as an ordinary loss in the year of the worthlessness. So of the $55,000, $50,000 is treated as an ordinary loss and it will be deducted on the current year's tax return. And the remaining $5,000 would be treated as a capital loss. And we know that with capital losses, there is a $3,000 maximum limitation. So therefore, assuming Minjung has no other sale of stocks, it would take 2 years to write this $5,000 capital loss off. $3,000 in the first year and in $2,000 in the year following. So B asks, what if the stock is sold for $500,000? So 500,000 minus the 60,000, this is a really great gain. So in such case, because the blue stock, as it lets us know, it's Section 1202, and it was acquired at original issue after September 27, 2010, he's allowed to exclude 100% of the realized gain, right? So with this Section 1202, again, there's some specific provisions in the tax code that basically helps to offset certain things. And with this Section 1202, this is one of the capital gains breaks. So Section 1202 is specifically refers to a taxpayer other than a corporation. And this basically allows capital gains from these small business stock to be excluded from federal taxes. So if you have stock that qualifies for Section 1202 and 1244, then hey, if you have a loss, you're going to benefit. And if you have a gain, you also benefit, as we see in this case. So because Minjung's gain is below the Section 1202 limitation, in such case, is able to claim 0. Or none of the recognized gain, rather, is taxable. In this question, it states, what gain or income, if any, will the parties recognize on a transfer? What basis do Maria and Bob have in the Robin Corporation stock? What is Robin Corporation's basis in the property and services it received from Maria and Bob? Maria and Bob form Robin Corporation. Maria transfers property worth $420,000 with a basis of $150,000 for 70 shares in Robin Corporation. Bob receives 30 shares for property worth $165,000 with a basis of $30,000 in legal services worth $15,000 in organizing the corporation. So Maria transferred property. Bob received 30 shares for property, and then he also contributed services. So we see in this case, this is one of those exceptions. So in this exception, as mentioned, generally as it relates to property it excludes services. But in this case, he contributed both services as well as property. So whenever that happens, we essentially need to determine, well, what is the value of the property that was contributed? And with the value of the property that was contributed, does it essentially, meet the relatively small value? So the legal services that he contributed was $15,000. So therefore, the IRS sets the rule that it's 10%. It has to be at least 10% of the stock that was received. So in this case, the stock received for services is 15%. If you multiply it by 10%, Bob would need to contribute property with a value of at least $1,500 to qualify for the control requirement of 80%. So 15,000 again represents the value of the services and the stock received for those services multiplied by 10%, which is the relatively small value set by the IRS. It is the nominal value that's also referred to, which is 10%. Has to be property contributed of at least 1,500. In this case, we see that the property has a basis of 30,000, fair market value of 165,000. So therefore, all of the property contributed by Bob constitutes and counts towards the 80% control requirement. So what gain or income, if any, will the parties recognize for the transfer? So in this case, Maria, she will recognize no gain or loss, $0. Bob, on the other hand, keep in mind, even though he counts towards the Section 351, because he contributed services, and as mentioned earlier, anytime a shareholder contributes services, those services are taxed at ordinary income for the value of the services provided. For B, it asks, what basis do Maria and Bob have in the Robin Corporation stock? So for a taxpayer that transfers property to a corporation in a Section 351 transaction, the stock received in the transaction is given a substituted basis. So essentially, the stock basis is the same as the basis that the taxpayer had in the property that was transferred. Then it would be increased by any gain recognized on the exchange of the property, and then decreased by any boot. So for Maria, she has a basis of $150,000 in stock. So therefore, her basis would carry over the $150,000. And then for Bob, he has a basis, in this case, of $45,000. How do we determine that? So we start off with the $45,000. Well, we start off rather with the $30,000, which represents his basis in the property, plus the $15,000 of the income that he has to recognize, minus any boot received. Bob did not receive anything other than stock, so 45,000 minus 0, his basis in the stock is a total of 45,000. So again, the stock basis is the same as though, the basis that the taxpayer had before the property was transferred. It's increased by any gain recognized on the exchange of the property or any income recognized. And then from there, it is decreased by any boot received. So Bob's basis in the property was 30,000. He recognized income of 15,000. He did not receive any boot, so 45,000 minus 0 is 45,000. C asks, what is Robin Corporation's basis in the property and services received from Maria and Bob? So the basis of property received by the corporation, generally it's determined, under a carryover basis rule. So this rule provides that the property's basis to the corporation is equal to the basis in the hands of the transferor. It's increased by the amount of any gain recognized. on the transfer of the shareholder. So in such case, Maria did not have any gains, so there's a carryover basis. Robin Corporation has a basis of $150,000. And in Bob's property, $30,000 would be the carryover basis. The $15,000 for the legal services that Bob provide, those expenses are going to be capitalized. They're going to be treated as organizational expenditures. They do not impact the corporation's basis in the property that was transferred. All right, this brings us to our next question. We are looking at the Schedule M1. So an important thing for us to keep in mind is the importance of the Schedule M1. There's what's called the M2. There's what's called the M3. So when you work on a return for a corporation, the corporation's tax return is Form 1120. And then depending on the nature of the business, you might or might not have these additional forms. So with the Schedule M1, this is essentially reporting any differences between taxable income and the book income. So one of the challenges is that sometimes there are certain things that can be reported for book purposes. So let's say tax exempt interest income. So on the books, on the accounting side, in the financial statements, we would recognize the tax exempt interest as income, but for tax purposes, it would not be recognized as income. So with the Schedule M1, it basically helps to account for any differences between the two. Schedule M2, that essentially accounts for any changes in the unappropriated retained earnings. And then M3 is essentially required whenever there's assets over $10 million. And whenever the assets are over $10 million, Schedule M1 and M3 are basically the same, but the key thing is that it requires greater detail because obviously, the assets are a lot. So it is required whenever assets exceed $10 million. For a smaller corporation, if total assets at the end of the year are greater than 250,000, they file the M1. But for smaller corporations that don't have assets that exceed 250,000, they don't need to worry about it. They don't need to file it. The M1 is not required, and neither is the balance sheet. But just keep that in mind. So here it's asking us regarding items that would be added back on an M1 schedule, label either yes, it would be added back to the net income, or no, it would not be. So for our Schedule M1, it's mentioned is used to reconcile net income as computed for financial accounting, our book purposes, versus taxable income that's reported on the tax return. So the starting point for our M1 is net income per books, and then from there we account for any additions and any subtractions, anything that would affect the net income per books and the taxable income differently. So for this problem, our federal income taxes per books, it's asking would these be added back? The answer is yes. The reason being is because a company records an expense for federal income taxes on their books. However, it has to be added back because federal income taxes is not an allowable expense when computing taxable income. Our excess of capital loss over capital gains, yes, it would be added back. So as we saw the problem previously, the excess of capital losses over capital gains, it's deducted for financial accounting purposes, but it's not deductible by corporations for income tax purposes. For corporations, they can only deduct losses in a specific tax year to the extent that they have capital gains. And in the event that for the year they do not have any capital gains, they can carry the losses back 3 years and then forward. Tax-exempt interest income. No, we would not need to add this back. Why not? So although it's recorded in book income, tax-exempt interest, it's not considered taxable. So therefore, it's not going to be included in taxable income. Next, we have excess of makers over book depreciation. So this would also be no. So most assets, they're depreciated faster for tax purposes than book purposes. So in such case, there would be an additional expense. There would be a subtraction from the book adjustment when necessary. It wouldn't be an addition, it would be a subtraction. Next, we have interest on a loan to purchase tax-exempt bonds. So this would be added back. And the reason being is because interest on loans to purchase tax-exempt bonds, it is deductible for financial accounting purposes, but not deductible by corporations for income tax purposes. So therefore, it would be added back. Then we have non-deductible meals and entertainment. So although there's an expense for meals and entertainment, it's taken per book income, the financial accounting purposes. The non-deductible portion of meals and entertainment, it's not considered deductible for tax purposes. So therefore, it would need to be added back. So for this problem, it's asking us to calculate the taxable income. So it'll be calculated as follows. We start off with our net income per books. And I'll actually pull up the spreadsheet. So it might be a little easier. All right, let's do it here and then I'll pull up the spreadsheet a little later. So we have net income per books after tax. We have 205,050. And then as mentioned, we need to add back our federal income taxes per book. So we add back the $55,650. We also need to add back the excess of capital losses over our capital gains. And to make it easier, here's what I will do. All right, so for the amounts that are going to be added back, I am going to make them green. And then for the amounts that are going to be subtracted, I will make those red. All right, so we start off with our net income per books, 205,050. We add back our federal income taxes per book. So 205,050 plus 55,650. We also add back the excess of capital losses over capital gains. We add back our interest expense on the loan to purchase tax-exempt bonds. And we also add back our non-deductible meals and entertainments. All right, so again, the green represents all of the amounts that we are added back. And then from there, we get a subtotal. Our subtotal is 276,700. And then we'll also account for these items on the form. So here we start off with the net income or loss per books, 205,050. We add back our federal income tax per books, 55,650. We add back our excess of capital losses over capital gains of 9,400. And then from there, we add back the depreciation, there's none. Travel and entertainment, the 5,500. the state bond interest expense of $1,100. So we add the two, 5,500 and 1,100 for a total of 6,600. And then when we add lines 1 through 5, as we already did, that gives us a subtotal of 276,700. So now for the next part of the problem, we account for the items that we need to subtract. So we need to subtract our tax-exempt interest income. Again, it is reported for book purposes, but it is not considered income for tax purposes. So we have our subtotal minus 4,500. And we also subtract the depreciation, which is the excess of makers over book depreciation. We subtract the 7,200. And then based on that, our taxable income will be $265,000. So that's how we calculated our taxable income of $265,000. But we complete our Schedule M1. So our tax-exempt interest will be $4,500. So income recorded on the books this year, not included on the tax return, the $4,500. And then for 8, it shows us deductions on this return not charged against book income this year, which would be the $7,200. Line 9, we add line 7 and line 8. So 4,500 plus 7,200, that will give us 11,700. So 4,500 plus 7,200 gives us 11,700. And now it asks us to subtract line 9 from line 6. So 276,700 minus 11,700. So our subtotal of 276,700 minus 11,700, taxable income will be 265,000. So again, the program will calculate this, but there's some information that you're going to need to input into the tax software. But for the most part, you input the information and then the program will generate it. For corporations that have assets that are less than 250,000, they do not need to complete this Schedule M1. For corporations that have assets that are more than 250,000 but less than 10 million, they complete Schedule M1. And for corporations that have assets that exceed 10 million, they need to prepare Schedule M3, which is similar to this M1, but it requires greater detail. All right, so this brings us to our last problem. It says, during the current year, Swallow Corporation, the calendar year C Corporation, has the following transactions. It says Swallow Corporation owns 12% of Brown Corporation stock. How much is Swallow's taxable income or NOL for the year? So we look at these side by side. We'll get our Excel back open again. All right. And the key thing in this case, we are dealing with the dividends received deduction. And we know that one of the key things that we need to consider is, well, what is the ownership percentage? The ownership percentage is going to have an impact on the applicable percentage. So here we look at this. All right. So for this problem, it lets us know that we have gross income of 660,000 from our operations. We have dividends of 240,000. I'm gonna make these a little smaller. All right, so we summed the two. 660,000 of gross income from operations and dividends received of 240,000. That gives us a subtotal of 900,000. Now from there, we need to factor in our expenses from operations. So the problem lets us know we have expenses of 760,000. So our income before the dividends received deduction is as follows: 900,000 minus 760,000. So our income before the dividends received deduction is 140,000. So similar to our previous problem, our dividends received deduction, the steps are as follows. We multiply the dividends received by the deduction percentage. We multiply the taxable income by the deduction percentage. And then we take the deduction, which is generally the lesser of step 1 or step 2, unless deducting the amount derived in step 1 results in an NOL. So we have the steps here at the bottom. So the dividends received is 240,000. And what we'll do it to the left. We know that it says that they own 12%. So because it's less than 20%, the applicable rate is 50%. So dividends received is 240,000 multiplied by 50%, which would be 120,000, versus taxable income before dividends received multiplied by 50%. We compare the 70,000 to the 120,000. So let's say if we claim the full dividends received in step 1, would it bring us to net loss? So because claiming the amount in step 1 would not bring us a net loss, we take the lower between the applicable percentage of dividends received by 50% or the taxable income by 50%. And again, because subtracting the 120,000 does not create a net operating loss, the dividends received deduction in this case is 70,000. So Swallow's taxable income after deducting the dividends received deduction is as follows: income before dividends received deduction minus the dividends received deduction. Taxable income is 70,000. So now we look at scenario B, where it says, assume instead that Swallow Corporation owns 26% of Brown Corporation stock. So same fact pattern, we have gross income from operations of 660,000, dividends of 240,000. We get that subtotal of 900,000. Our expenses from operation is 760,000. And we have our income before the dividends received deduction of 140,000. But now in this case, because the ownership percentage is more than 20%, the dividends received deduction percentage is now 65%. So in order to determine the amount, we first multiply the dividends received deduction by 65%. So 240,000 multiplied by 65%. In comparison to the taxable income multiplied by the applicable percentage. So if we compare the two, 156,000 represents 65% of the dividends received versus 65% of taxable income before the deduction. So if we were to claim the amount in step 1, would it present a net operating loss? So 140,000 minus 156, it would create a net operating loss. So therefore, we disregard this rule because again, step 3 says the deduction is limited to the lesser of step 1 or step 2 unless deducting the amount derived in step 1 results in a net operating loss. So because claiming the amount calculated in step 1 creates a net operating loss, and this second fact pattern swallows net operating loss after deducting the dividends received deduction is $16,000. All right, so this brings us to the end of the questions from Cengage Corporations, Partnerships, and Estates. Again, we covered Chapter 2, which deals with the qualified business income deduction. Chapter 3, or Chapter 2 rather, and 3, which dealt with corporations, introductions, and operating rules in Chapter 4, which covered corporations, organization, and capital structure.